Yo, what is going on, guys? Welcome back to another video. So today's video is actually going to be very important, and it's a topic that's not discussed by many people. And today's topic is going to be in regards to liquidity, and in specific internal and external liquidity and the differences of them and how we use them and how we find both of these two different types of liquidity. Now, essentially liquidity is all the same, and I'm not going to break down what the meaning of liquidity is in this video. There's a lot of YouTube videos out there that explain the basics of liquidity, but essentially we understand that in order for the smart money to move throughout the market, they need liquidity. Okay, and they're not able to just place massive lots if they want to get into the buy or if they want to get into a sell. So a lot of the time, in order for them to make a really big move, they need traders on the opposite side of the market, okay, to eventually be stopped out of their position in order for them to sell their position back to the market. And the institutions, the hedge funds, etc., all these big players are able to then capitalize on these open contracts, okay, so they can actually get their positions filled. Okay, so they need to stop you out of your position. It's non-personal, but in order for them to get filled into their contracts, they need to clear all of that liquidity and get these traders to sell their contract back to the market. Okay, so we have two types of liquidity, as I said, and we all know what the different areas of liquidity are. They're simply just relatively equal highs, relatively equal lows, double tops, double bottoms, major lows, major highs, etc. Nearly everywhere in the market there's major areas of liquidity. There's a lot, and we have areas such as the highs right here. And this is called external liquidity. Essentially, external liquidity is always going to be on the outside of the range. So if we take a look at this range right here, the outside liquidity is always on the outside of the range. Okay, and this is the liquidity that we usually like to target if I'm within a position. So let's say I enter a buy position right here. We use external liquidity as targets. Once I go into another buy position here, I target this liquidity. We enter another buy position here, I target this next high. This is external liquidity. And now we have something that's called internal liquidity, and this is the liquidity that is within here. So that is the liquidity within the range. This low, this low, this low. Why do we call it internal liquidity? Because it's simply within the range. As you can see, as price comes back down, this low is being cleared, this low is being cleared, and this low is being cleared, and then price goes back up. So a lot of time you see something like this, okay, where the price goes back up. This is all internal liquidity. What's the differences between both? Well, for me, the external liquidity, such as the liquidity here, for example, I use this as a target. So if I get into my position right here, okay, I use this as a target. Now, most people understand liquidity just from the external perspective, where they just look at external liquidity. They find the area of the liquidity, such as this high right here, and they're like, this is the area of liquidity where traders might have the stop losses, etc. So we're going to target this from the buy. Perfect. But a lot of people miss the fact that you need internal liquidity is in fact nearly more important than the external liquidity itself, because it is the fuel for these moves that are occurring. So think of it this way: internal liquidity is the fuel for your move, and the more fuel, the further you can go. So a lot of time what you'll see in the market is the market simply just can't go all of the time just like this. It eventually runs out of fuel. Okay, so a lot of time what sometimes you'll see is, and this is called a fake change of character, where price will sometimes come down. It will look like a change of character or a break of structure, but in fact price just wanted to come down, clear this low as liquidity, as a lot of people potentially had their stop losses below here. People had sell stops, etc. So so the market will come down here, purge this low, and then actually react and respect the demand from here and continue up. And these are the trades that we want to look for. So a lot of the time, if you find price just go a very fast expansion up and then a very fast pullback down, and you expect the market to go back up once again, this is very unlikely, and a lot of people get caught into these type of order blocks and the price doesn't eventually go in their way. You need liquidity to build up. Okay, you need liquidity to build up right around your point of interest, or you need inner liquidity, a lower here, some sort of lows or support, just above your demand right here in order to push price up. Okay, it's the fuel. Now we take a look at this right here, for example. We take a look right here. We had one high, one high, one high, one high. We had a nice trend line right here. This is some nice trend line liquidity. What does the market do? In order for the market, okay, to have pushed down from this, you see this big imbalance right here? In order for the market, and this is 50% of the imbalance, is a very, very nice imbalance fill and then a drop. In order for the market to have made this massive move down, it needed to clear a huge amount of liquidity. It needed to clear, okay, all of this liquidity, which is all inner liquidity because it's internal in the range. If you take a look at the range, down, up, and just take a whole look at this. This is all internal liquidity because it's on the inside of the range. Okay, so the market cleared all of that liquidity here, cleared that high, and even as we were stepping along, look how much liquidity it was clearing every single time before eventually it made its move down. Now, where you take a look at something like this, for example, where you had absolutely no liquidity cleared, a lot of people would have looked to enter on the sell from here. And this, for me, wouldn't have been a good point of interest. I mean, the order block looks good, it's in the premium, etc. But there was actually no real inner liquidity for us right here. The market came up really, really quick. We had no real true amount of orders accumulating right here. So you'd want to see some sort of manipulation, some sort of liquidity. The only liquidity that we had right here potentially would have been, you know, this high. Sometimes this works, but all in all, look, even though it did react, it didn't make the move that you wanted to see, which a lot of people would have been targeting this low. So you need to be very, very realistic in where your target is, dependent on the amount of liquidity that the market accumulated and purged. Whereas when we take a look at something like here, for example, okay, there's a very nice example right here where you had something like this. Look at the amount of liquidity the market built here. Look at this huge amount of liquidity. This is all a support. And just right below that support, we had this point of interest right here. And this was the area where we would have wanted to buy from. Now think of all the people, including smart money traders, are looking to buy from here. And look, like looking to buy from here, for example, and price will go in the direction a little bit. The trade was successful, but not in the way that people wanted to target these highs or these highs. Like you can't have this amount of liquidity grab just this low, for example, and expect price to go all the way here. You have to be very realistic. Whereas now look what happened, where we had all of this liquidity, all of these stop losses, came down, cleared it very sharply, tapped into my point of interest, and now look at that move. This is the real move. If you want to be catching these proper big impulsive moves, wait for a lot of liquidity to build up first of all, and then look to get into your position. So you will end up avoiding a lot of manipulation by simply just waiting for the liquidity to build up and then getting into your position. I'm going to show you one more example. So look at this range here, for example. A lot of people would have wanted to get in on this order block, believing, look, whoops, right here. So a lot of people would have wanted to get on this order block, believing, okay, broke structure, etc. Looks great, all on paper. Let's get into the buy. There's actually no true amount of liquidity right here that's been built up. So if there's not a lot of liquidity that's been built up, and there's 2 points of interest, 1 and 2, a lot of the time, the first one actually ends up being the inner liquidity itself. So I'd actually leave this one, especially since there was no liquidity right here, just the highs right here, but this is way too far. So we need to see some sort of liquidity purge right here, and we don't see that. So this is actually going to end up being the liquidity purge itself. This is the low that we're going to see before, that we're going to see grab before actually making the move up. And eventually, price does, grabs that liquidity, taps into my lower point of interest. Okay. And then away price goes. Just like so. Away it goes. We take a look at even gold in the most recent time. Look, before it made this big move up, look at the market structure. Multiple liquidity grabs. Think of all the people that are looking to get in on the setup early. They're all part of the liquidity. The goal right here, guys, is not to be the first participants in the market. You want to be the last one. Okay, this is contrary to popular belief, but I want to be the last one in. I want to be getting in right after all the manipulations occurred. Okay, right after I want to get in right after all the manipulation has occurred right here, and I get in. Now, how would you do this? A lot of people will be very, very confused on how to do this, and I actually have a very, very good solution for that. What I use is the order flow footprint tool. Okay. Now, the order flow footprints tool might actually look very, very confusing, but in fact, it's not. It's very, very simple. And essentially all it tells me, right, is it gives me information in regards to the delta. The delta is the net difference between the buyers and the sellers. Now, the understanding of the buyers and the sellers, okay, is actually going to help me determine if these lows right here are actually proper lows that are not going to be tested anymore or not. A lot of the time when you're looking at the order flow, you're going to be able to tell that this is simply just going to be a weak low, and price is eventually going to run through that. Okay, because you'll be able to tell how many buyers or sellers are backing that high or low, and that's very, very powerful, and it helps you avoid getting slapped out as liquidity out of your position. For example, a lot of time when you take a look at the order flow, you will see that the order flow on this move right here was much, much different to the order flow on these moves right here, and that is essentially my secret on how I'm able to catch these setups and getting last into the market. Now, if you don't understand what order flow is, literally go right now to the link in my description. There's a link to a video, and potentially will pop up as a card right here as well. And that's going to explain to you order flow in absolute basic form. Okay, so it's going to simplify order flow, explain what order flow is and how you can use it in your SMC or ICT strategy. That's pretty much it, guys, for this video. Nice, sweet, short, and simple, explaining external and internal liquidity. If you didn't understand the video, make sure to watch it again, because this is very, very important. And yeah, with that being said, appreciate every single one of you for watching all the way through to the end. Make sure to join my free Telegram mentorship as well. The link is in the bio. Click the follow button. I mean the subscribe button. I keep messing up thinking this is subscribe sometimes. But yeah, give the video a like as well, and I'll catch you guys on the next lesson. Have a great day.